What if I told you that the world's greatest investor, a man who survived the 1987 crash, the dot-com bubble, the 2008 collapse, is now sitting on the largest cash pile in human history and refusing to touch it? $334 billion. Sitting idle. Not buying stocks. Not buying businesses. Just waiting. And when Warren Buffett waits like this, history has always proven something enormous is about to shatter. So right now, before you scroll away, before you close this video, ask yourself one question. Are you prepared for what is coming in 2026? Because what you are about to hear in the next 20 minutes could either save your financial life or remind you that you had every warning and chose to ignore it. To understand what Buffett is seeing right now, you need to understand who this man truly is. Warren Edward Buffett was born in 1930 in Omaha, Nebraska, a city far from Wall Street, far from the noise, far from the greed. And maybe that distance is exactly what gave him clarity that others never had. At 6 years old, while other children played in the streets, young Warren was buying 6-packs of Coca-Cola for 25 cents and reselling individual bottles for a nickel each. He was not playing a game. He was building a system. At 11, he bought his first stock. At 13, he filed his first tax return. By 15, he had saved over $2,000, money he had earned, counted, and protected with a discipline that most adults never develop in a lifetime. He went on to study under Benjamin Graham at Columbia University, the man who invented value investing. And Graham drilled into Buffett 2 rules that would define everything. Rule 1, never lose money. Rule 2, never forget Rule 1. Those 2 rules sound simple, but in a world drunk on speculation and greed, they are the hardest rules in the world to follow. Buffett took those rules and built an empire. Berkshire Hathaway today owns Geico Insurance, BNSF, Railway, Dairy Queen, See's Candies, and massive equity stakes in Apple, American Express, Coca-Cola, and dozens of other blue-chip companies. For over 6 decades, this man has beaten the market, beaten the economists, beaten the analysts, and beaten every financial crisis that tried to bring him down. So when Warren Buffett suddenly changes his behavior, the entire world of finance stops and listens. And right now, his behavior is sending one signal, loud and clear. Danger is coming. Here is what most people missed. In 2024, Buffett did something that sent shockwaves through every trading floor on the planet. He began selling. Not small positions. Not minor adjustments. He sold over 60% of his Apple holdings. Apple, the company he had called the best business in the world, the crown jewel of Berkshire's portfolio. He sold billions in Bank of America shares. He quietly exited positions he had held for decades. The man who preaches, never sell a great business, was selling. And the question every analyst, every hedge fund manager, every retail investor was asking behind closed doors was the same. What does Buffett know that we don't? The answer lies in a single indicator that Buffett himself created and that bears his name. The Buffett indicator. It is breathtakingly simple. You take the total market capitalization of all publicly traded companies in the United States and divide it by the country's gross domestic product, the total value of everything the economy actually produces. When that ratio is around 100%, markets are fairly valued. When it rises to 120%, Buffett gets cautious. Right now, as we move into 2026, that indicator sits at over 200%. 200%. That means the stock market is valued at twice the size of the entire American economy. The last time we saw numbers even close to this was the year 2000, right before the dot-com bubble erased $5 trillion in wealth. Buffett is not panicking. He never panics. But he is prepared. And his preparation looks like cash. Mountains and mountains of cash. Now let us talk about debt, because this is where the Titanic metaphor becomes terrifyingly real. The United States government currently carries over $36 trillion in national debt. Let that number sit in your mind for a moment. $36 trillion. In 2024 alone, the U.S. government paid over $1 trillion just in interest payments on that debt. Not paying it down, not reducing it, just the interest. For the first time in American history, interest payments on the national debt exceeded the entire defense budget. The ship is not just taking on water. The water is rising faster than anyone can bail it out. And here is the part that keeps economists awake at night. Interest rates are not coming down fast enough. The Federal Reserve, after years of near-zero rates, raised rates aggressively to fight inflation. Those higher rates mean every new dollar of debt the government borrows costs more to service. It is a spiral. Borrow more, pay more interest, need to borrow more to pay the interest, repeat. This is not a theory. This is arithmetic. And arithmetic does not care about political speeches or Wall Street optimism. But the debt story does not end with governments. Corporate America is drowning too. After a decade of ultra-cheap borrowing, thousands of American companies loaded their balance sheets with debt at interest rates that seemed manageable when money was essentially free. Now those loans are coming due. In 2025 and 2026, an estimated $10 trillion in corporate debt needs to be refinanced, but at today's interest rates, not the near-zero rates of the past decade. Companies that were barely surviving on cheap debt are now facing a brutal reality. Refinance at higher rates and crush your profit margins, or default and face bankruptcy. This wave of refinancing has a name on Wall Street. They call it the maturity wall. And in 2026, we are walking straight into it. Commercial real estate is another crack in the hull that most people are not watching closely enough. Office buildings across America's major cities sit between 30 and 50% empty, a permanent scar left by the remote work revolution that the pandemic accelerated. These buildings were financed with hundreds of billions in loans that are now coming due, loans backed by properties worth dramatically less than when they were written. Regional banks, the kind that lend to small businesses, to farmers, to your local community, are heavily exposed to this commercial real estate collapse. Several regional banks have already shown severe stress. And history tells us clearly, when regional banks start falling, the contagion spreads faster than any regulator can contain it. Now here is where you need to ask yourself a deeply personal question. Where is your money right now? If you are like most people, you have money in a 401k or retirement account heavily weighted toward U.S. stocks. You might have some money in a savings account earning modest interest. You might own a home. You feel financially okay. Not rich, but stable. But stable is exactly how the passengers on the Titanic felt before the iceberg. The ship was the largest, most technologically advanced vessel ever built. The engineers called it unsinkable. The passengers trusted the experts. And then reality disagreed with the experts, as it always does, eventually. Buffett's preparation tells us everything. He is not selling because he has given up on America. He loves America. He has said repeatedly that betting against America has always been a mistake. But there is a difference between believing in a country's long-term future and believing that current market prices make any rational sense. Right now, Buffett sees prices that make no rational sense. He sees a market where artificial intelligence hype has driven valuations into the stratosphere. He sees a market where retail investors, armed with trading apps and social media tips, are pouring money into assets they do not understand at prices they cannot justify. He sees the same psychology he saw in 1999, the same cocktail of euphoria, leverage, and willful ignorance of risk. And so he waits, patient, silent, cash in hand. Let us talk about what a 2026 financial crisis might actually look like, because understanding the mechanics removes some of the fear and replaces it with actionable clarity. A crisis does not begin with a single dramatic explosion. It begins with small cracks. A mid-sized bank reports unexpected losses on its commercial real estate portfolio. Depositors get nervous and begin quietly moving money. Another bank follows. Credit markets tighten slightly, not dramatically, just slightly. Companies that were planning to refinance their debt find lenders are suddenly less generous. A few high-profile corporate defaults make the news. The stock market dips 5%. Financial media calls it a healthy correction. Then another crack. Then another. And then one morning, the market opens down 10%, and the word that everyone has been pretending does not exist finally appears on every screen. Contagion. This is how it happened in 2008. Not all at once. Slowly, and then all at once. The Federal Reserve will respond. They always respond. Interest rate cuts, emergency liquidity programs, perhaps another round of quantitative easing. And in the short term, these tools work. They stop the bleeding. But they also plant the seeds of the next crisis, because they add more debt to a system already choking on debt. Buffett understands this cycle better than almost anyone alive. He has watched it play out multiple times. He does not fight the Federal, But he also does not pretend the Fed has eliminated risk. The Fed can delay a reckoning. It cannot cancel one. So what should an ordinary person, not a billionaire, not a hedge fund manager, just a regular human being trying to protect their family, actually do with this information? First, understand that cash is not a dirty word. In a world where every financial advisor tells you to stay fully invested at all times, holding some cash feels wrong, feels like you are missing out. But Buffett is holding $334 billion in cash precisely because he wants optionality, the ability to act decisively when others are paralyzed by fear. You do not need billions. But having 3 to 6 months of living expenses in liquid savings is not just financial advice. In 2026, it could be a lifeline. Second, look at your debt. Variable rate debt, credit cards, adjustable rate mortgages, lines of credit, becomes a weapon pointed at your own head when interest rates stay elevated. If you carry variable rate debt, reducing it aggressively right now is one of the highest return investments you can make, because the return is the interest rate you stop paying. Third, diversification is not just a buzzword. It is armor. If your entire financial future is tied to U.S. large-cap stocks and U.S. real estate, you are not diversified. You are concentrated. Buffett himself holds international positions, holds commodities exposure through Berkshire's subsidiaries, and of course holds that enormous cash reserve. The lesson is not to copy Buffett exactly. The lesson is to think about what you own and whether it can survive different scenarios. There is something else Buffett has said that people consistently underestimate. He has spoken about the importance of investing in yourself, your skills, your knowledge, your ability to generate income regardless of what the stock market does. In a financial crisis, the people who suffer the most are those whose only asset is a portfolio and whose only income is a job that disappears when companies cut costs. The people who survive and even thrive during downturns are those with diverse income streams, rare and valuable skills, and the mental resilience that comes from having thought about adversity before it arrives. This is not pessimism. This is preparation. There is a profound difference between the two. Warren Buffett will turn 96 years old in 2026. He has seen more economic cycles, more crashes, more recoveries, more moments of human financial madness than almost any living person. And in all those years, his philosophy has never changed. Be fearful when others are greedy. Be greedy when others are fearful. Right now, the market is drunk on greed. AI stocks with no earnings trade at hundreds of times revenue. Meme stocks surge on social media hype. Retail traders borrow money to buy options they do not understand. The mood is euphoric. And Buffett is sitting quietly in Omaha, adding to his cash pile and waiting. When the fear comes, and it always comes, he will deploy that cash. He will buy great businesses at terrified prices. He will do what he has always done. And a decade from now, people will write articles marveling at his genius. But it is not genius. It is discipline. It is patience. It is the willingness to look foolish in the short term to be right in the long term. The 2026 financial Titanic, if it strikes its iceberg, will not destroy everyone. It never does. Every crisis in history has had winners alongside the losers. The winners are not necessarily the smartest or the luckiest. They are the ones who paid attention to the warnings, who acted before the crowd, who kept their head when everyone else lost theirs. The iceberg is visible. The warnings are real. The question is not whether you can see them. The question is whether you will act on what you see. Warren Buffett is acting. The question now is whether you will too. If this video made you think differently about your finances, about your future, about the world you are living in right now, then do one thing before you leave. Share this with one person who needs to hear it, not to spread fear, but to spread awareness. Because the best financial decisions are made with clear eyes, honest information, and enough time to act before the moment of crisis arrives. The time is now. The warnings are here. And unlike the passengers on the Titanic, you have been told,